Have you ever noticed how some traders anticipate explosive moves before they happen? Well, there's an indicator for that has helped them for decades. It's called the Bollinger Bands, and whether you're a beginner or someone who already spends hours looking at the charts, this indicator could completely change the way you understand price movements. But be careful, most traders misuse Bollinger Bands or don't really know what they reveal. In today's video, we're going to explore everything in depth, and I'll even test a trading strategy right before your eyes. First of all, what are Bollinger Bands? Imagine them like an elastic band around the price. When the market gets excited, the elastic stretches, and when everything is calm, it relaxes and tightens. Bollinger Bands were created by John Bollinger in the 1980s to measure volatility, a technical term that refers to how wildly the price moves. On a chart, you typically see three lines: a middle band, an upper band, and a lower band. The middle line is simply a moving average, usually a 20-period moving average. The upper and lower bands are set at a certain distance, usually 2 standard deviations from this moving average. To simplify even more, when the market is very calm and there is very little volatility, you can see that the Bollinger Bands tighten, as was the case here and once again here. And more precisely, even in this very low volatility environment, the Bollinger Bands got even tighter here. But when volatility returns and the market goes wild, you can see that the Bollinger Bands then expand, as was the case on this bullish move right here. Then volatility contracted again and the Bollinger Bands got tightened once more before another explosive move where the Bollinger Bands expanded again. So we can clearly see this phenomenon of contraction before an explosive move, in this case to the upside, where the Bollinger Bands then expand. Here we have another contraction phase of the Bollinger Bands before they expand and we get another explosive move. And you see, these bands, they are never fixed. They move, they stretch, they contract. In fact, they give you a real-time reading of market volatility. Now that you know how to visually recognize the Bollinger Bands, let's look at how they work with an analogy that everyone can understand. Imagine your body has a natural sleep rhythm. Suppose you sleep 7 hours per night on average. Well, this average, the 7 hours, this is your middle line. But some nights you sleep a long 10 hours. And other nights you binge watch a TV series and sleep barely 4 hours. These two extremes, too much or too little sleep, represent your upper and lower bands. The upper band, your body tells you, wow, you really recovered there. And the lower band, the 4-hour sleep, it tells you, oh damn, I'm exhausted, I can't take it anymore. But be careful, just like with sleep, hitting one of these extremes isn't necessarily a sign of a big problem. If you're training for, let's say, a marathon, then sleeping 10 hours a night is normal. And if you're pumped with adrenaline, then having a short night won't necessarily crash you. So the context is what really matters. And in trading, it's the same. Bollinger Bands show you how price behaves relative to its recent average. Just like sleep shows you how your body managing its needs depending on your recent life context. That's the kind of intuition Bollinger Bands give you. They don't just tell you where price is, they tell you how it's behaving compared to its recent norm. So let's get back into the action and look at different ways to use Bollinger Bands. The first is the Bollinger Squeeze, a classic. As we mentioned, when the bands contract significantly, it indicates very low volatility. And often, right after, you get a very big move. Think of it like a pressure cooker building up steam. When it blows up, it's rarely small. But let's not lie to ourselves there, because we know that determining in advance the direction of the explosive moves that will follow the contraction of the bands, that's no easy task. Therefore, to increase the odds of finding the right direction, you can use other momentum indicators, like the beep boop, for example, here at the bottom of the screen, that we mentioned in another video. You could also use other indicators like the super trend or the half trend, or you can see how price action behaves. For example, when you see that we have a consolidation phase, you can check what type of move preceded that consolidation phase and the contraction of the Bollinger Bands. For example, let's see. Here we had an impulsive move to the upside that was followed by a contraction. Therefore, when you get a contraction like this, you can check what type of move preceded it. It was an explosive move to the upside, which could indicate that the next likely move will also be in the same direction, therefore to the upside, and that's what we get here. Then another horizontal phase here with a contraction, and a last move to the upside before we consolidate. Then we get out of this consolidation phase now to the downside. So next time we get a contraction phase right here, we check what type of move preceded it, a bearish move, explosive to the downside. So we can assume that the most likely next move will also be explosive to the downside, and that's what we get here. So this is a very basic framework of how you could check price action when using Bollinger Bands. When you see a sequence of impulsive, corrective, impulsive moves towards one direction, it's likely that this sequence will continue until it's reversed to the other direction. So if you can read price action well, then identifying those contraction phases on the Bollinger Bands can give you a good timing to position yourself before the next explosive move happens. Now, the second way to use Bollinger Bands is to identify potential reversals. If price touches the upper band, then stagnates or starts going down, that could potentially be a reversal signal. On the opposite, if price touches the lower band and stagnates or starts going up, that could potentially be a reversal to the upside. But again, you want to maximize the odds of the reversal really happening rather than just trading every touch of the upper or lower band. And you can look for extra confluence in the form of RSI divergences. So I coded myself an indicator to detect them at a glance, but we can see that when price went beyond either the lower or upper band and we had a divergence at that time, it gave pretty good signals. So when we touch the lower band and we get a bullish divergence, well, this one did not work pretty well, but we had the case again once again here. Price goes below the lower band and we get the bullish divergence. So when price reintegrates the band and goes back above, then this could be the reversal signal. We had now a sell signal right here, then another one occurring right here, then a buy signal right here, worked out pretty well. Then we got this one again here, nothing here. Here we didn't go above the band, and we got another buy signal right here. This might not be an entire trading strategy in itself, but it greatly improves the approach of using Bollinger Bands for reversals, especially if you see a range taking place. Then if you want to trade the upper and lower bounds of that range, then using Bollinger Bands with divergences could be a good approach. I find these two indicators complement each other pretty well. But if you can, let me know in the comment sections if you already use Bollinger Bands, and if yes, how so? Another interesting thing is you do not have to always use default parameters on the Bollinger Bands. For example, you could tweak them a bit. Instead of using 2 standard deviations to place the upper and lower band, you could bump that up to 2.5 standard deviations to make the touches and crossovers over the extreme bounds even more rare. I also know that some traders who like to use Bollinger Bands do not use divergences to detect reversals when price crosses above the band, but use candlestick patterns, for example, engulfing candlesticks. If we do that, we can see that we had an engulfing candle right here after price closed below the lower band. So this signal would have been the same. We would not have gotten that signal. Here, no engulfing candle either right after we cross the Bollinger Band, the upper band. Here, we close above the band and immediately get an engulfing candle, so this would have also been a signal. Here, we do not immediately get the engulfing candle, so no signal here. No signal here either, but we would have gotten this one as well. So overall, you can see that by either using divergences or engulfing candles, some of the signals will be the same and some will be slightly different. So this is another tweak that you could definitely backtest. Speaking of candlesticks, that brings me to the third way of using Bollinger Bands, trend continuation. In a strong trend, price can quote-unquote stick to a Bollinger Band. As we can see here in this upper trend on the S&P 500, the price really came and hugged the upper Bollinger Band. And that doesn't necessarily mean it's overbought. It's more of a sign of momentum. Check out this recent uptrend that we had on Ethereum. As you can see, price really hugged the upper band of the Bollinger Bands because momentum was very strong. And by the way, check what happened before. We had a contraction move, or also called a corrective move, with a contraction of the Bollinger Band, which was preceded by a strong upwards move. So the most likely scenario after we had that contraction in that range was another move to the upside. This kind of situation where price comes and really sticks to a certain Bollinger Band, whether it's the upper band or lower band, it can really be exploited. If price really rides the upper band, like it was in this case, then you mustn't try to trade counter trend. In fact, let's actually test this strategy. So I'm gonna go on the upside platform and we'll try this strategy on Bitcoin. So I'll select BTC USDT from Binance. And let's just say the strategy rules will be on a 4-hour chart, buy when price touches the upper Bollinger Band, and we'll use a 2.5 standard deviation. So I'll just say standard dev 2.5. We'll also want to short when it touches the lower Bollinger Band. So I'll say short when it touches the lower band. Okay, so these will be our entry rule for a long or a short. And to close the position, we'll just use a fixed number of candles. So let's say, for example, we want to ride the momentum for a certain amount of candles. So we'll say close a position, let's say 3 candles after it's been open. Okay, we'll test that over the last 8 years. On each, we will invest, well, we'll put 10% of our capital, and we will allow more than one trade at once. So these rules are pretty clear, pretty simple. Let's see if they're effective. I'll start the backtest and I'll see you for the results. By the way, if you want to do the same thing, test any strategy idea that comes to mind, you can do the same thing for free. You can just go now on upside.com. You'll find the link in the description below. Okay, the results are here. Let's see what we got. All right, it did decently well, if I might say, for such a simple and basic strategy. Over the last 8 years, the max drawdown, which I guess it currently is in, was only 13% for now, with a total return of 55%. So that's around 6% annualized for such a low drawdown. That's acceptable. It wins quite often. The win rate is 47% and the average RR 1.36, which brings it into profitable territory. As we can see historically, there has been quite a steady growth of the capital, but it struggled a bit more over the last 12 months. It would be interesting to forward it from now on, forward test it, and see how it behaves in the next few months. There's definitely room for improvement here, and I'm sure you will find some better ideas using Bollinger Bands or not, actually. But as you saw, in literally 2 minutes, we were able to see if a strategy works or not. And you can do the same. As I said, upside.com, you can start for free. Now let's do a quick recap. Bollinger Bands can be effective, but remember that they are not a magical tool. The first mistake to avoid is to think that Bollinger Bands are like fixed barrier. They are absolutely not. As we've seen in strong trends, price can literally stick to the Bollinger Bands for quite some time. The second mistake traders make when trading Bollinger Bands is to trade them without additional confirmation. As we've seen, adding stuff like RSI divergences or candlestick patterns after price touches or crosses the lower or upper band can really improve the signal quality. And finally, third mistake is to forget the overall context. You must look at the market as a whole. We've seen that by looking at the move that preceded a contraction phase, we can likely determine the direction of the next explosive move. All in all, Bollinger Bands are not made to be traded alone. They are made to support your decisions, not replace them entirely. If you like this video, make sure you leave a thumbs up. You can also comment and subscribe. That will definitely help the channel. As for me, I'll see you in the next one. Bye.